Hi, and welcome to the weekly market update from Morton Brown Family Wealth. I'm Dennis Morton here with Katie Brown and Cody Demmel. How are you guys doing?
Great.
Good.
How are you?
Good to see you. So this morning we're going to talk about the best long-term investment. We're going to dive into some thoughts on recency bias, what it means to be looking at the last thing that happened. And finally, we'll talk about the Federal Reserve and unprecedented action that just started this week. So let's start off. Katie, you found an article on the best long-term investment between different asset classes. What did you find?
I found an article and it was published by GetRichSlowly.org. And it surveyed individuals to ask what they thought the best long-term investment was. And it was things, CDs, bonds, real estate, or equities. 35%, the largest, thought that real estate was the best long-term investment, whereas 21% thought stocks was the best long-term investment. Stocks is the best long-term investment by an average. They've averaged about 10% returns going back to 1850. Real estate's averaged about 6%. But I think a couple of things that's really interesting in the article is we know historically stocks return strong returns on an average, but they never actually hit that average. And so we have years where stocks are up 15%, and then they might be down 10%. And I think that's something we often talk about with our clients. On the average, it makes sense to hold a portion of the portfolio in stocks, but it has to be with the understanding that we're going to have really good years and we're going to have really bad years. But on average, we're going to capture that return. Whereas I think real estate sometimes feels like a better investment because you don't get the daily valuation on it. And it just seems like the slow and steady build, which it can be. But one thing I thought was really, I think they did a good job pulling out or separating in this article was that actual housing returns have only been about 1%. That difference, actually slightly less than 1%, that difference of return is from rental income. And so it's all about how you invest in the real estate market too that's going to make up that difference.
Yeah, and then we always talk about the carrying cost too. There's the idea of when we look at a stock, we don't, we're factoring in expenses, the trading costs, anything that goes associated with it. But are we factoring in the, the mortgage interest or the property taxes or the new roof you need to put on the house? Once you factor all of those things in, the math changes a little bit. So it's a different comparison. What did you pull out of that article, Cody?
Yeah, I thought that was a really good article that Katie pulled forward. One of the interesting things I thought was when they did the study back in 2011, 35% of the respondents thought gold was the best, and now it's only 16%. And I also thought it was interesting between both 2011 and 2020, 15% of the responders thought CDs or a savings account was the best long-term investment.
Yeah. And I think the key to this is of all of those things, they should all serve a purpose. If you're counting on your stocks to be short-term, you're going to be disappointed. If you're counting on your cash to be long-term, you're going to be disappointed. Each one has its sleeve and has its role. It's when we start trying to apply it for all seasons and in all circumstances, that's when we get in trouble.
I was going to say that leads right into the other article that you were talking about, that recency bias.
Yeah. So there's this, we found an article actually there was one in Morningstar, and Katie, you also found one in Harvard Business Review covering something very similar, which is these mental shortcuts that we take to make decisions. So sometimes when we're trying to understand the world around us, we shortcut to the most recent thing that happened and then try and make decisions based on that. And, the pitfall is that you end up making decisions based on past returns. And this may indicate, Katie, some of the reasons why people would assume that certain assets outperform and certain others don't. I remember back in 2006 when I was talking to people about investing, and the most recent thing that they could remember about stocks was the tech bubble bursting. And I would often hear, why would I buy, a stock when that just happened? I lost 80% in the NASDAQ. I'm going to buy real estate. That never goes down. And then we all know how that played out in 2007, 8, and 9. So sometimes if we're looking at what just happened, we miss kind of the things that are right in front of us or the other things that are building. What did you see in the Harvard Business Review article, Katie?
The biggest thing that I really pulled from that article is trying to move away from thinking in absolutes and more to the probabilities. And so, and it plays right into that. So we find ourselves in a situation right now where we see stock markets moving in any one direction to think it's going to continue to go down, or it's going to continue, and to try to pull away and say, okay, over time, to kind of stretch out over time, what is the probability of a recovery? What is the probability of different asset classes performing different ways, and not abandoning whole pieces of the asset allocation.
Right. I think that there's that idea of how to avoid it too. Is what are the filters that you can put in? Some of it is things that we do. The way we filter our news. Like, none of us have TVs on our desks at work, so we're not constantly being bombarded by the most recent things that have happened. But also having outside sources. I mean, sometimes that's the role of an advisor, is to be that filter. It helps you say, all right, ignore that, focus here. Last thing we wanted to talk about, Cody, this is a this week event. The Federal Reserve is doing a lot of buying, but what are they buying this week that's so different from what they've done before?
Yep. So yesterday, the Federal Reserve actually started buying corporate debt ETFs. It was the first time they've ever done that. They said they'll be targeting what they called fallen angels, which are companies that were classified as investment grade before the coronavirus crisis and have been downgraded since. And also, what I thought was really interesting is, since they announced they were going to start buying these corporate debt ETFs, the corporate debt market has actually gone up 69% from last year.
So that's new issues. That's new.
Yeah.
Wow.
Yeah.
So, I mean, the narrative over the last 10 years is low interest rates allow companies to issue debt at a low cost and fund operations, everything else. Now they're using it kind of as an emergency backstop. Like, we need this cash now.
Yeah.
I think it's interesting because we've talked before about how many companies are rated just above junk status. So they're investment grade, but they're barely above junk. And if a stiff breeze were to come, a lot of those would, fall into junk territory. And a lot of these funds can't own them anymore. So who's going to buy the funds that are being sold? Well, now we kind of know the Federal Reserve is stepping up those operations. So unprecedented stuff. Katie, what are your thoughts kind of on the, what to do as an investor when you look at all this activity happening?
I honestly, my advice doesn't change a whole lot. I think it's still stick with a plan, stick with a diversification. And I mean, if there is something in your world that calls for a revisit of the plan, great, that's fine. But I would not let that outside force change your track to any great degree. It still comes back to your risk profile and what you need for your family.
All right, so let's wrap up on spring cleaning. So the weather's finally turning here in Eastern Pennsylvania. There's household projects to be done. We've all been staring at them for a little while. Cody, what's top of mind for you for spring cleaning?
Yeah, so as mentioned before, Courtney and I got a new puppy who unfortunately started digging holes. So I will be filling those and hopefully training him on not to dig, and then also just some other things around the house, especially yard work when the weather gets nicer.
Sounds good. Katie, what about you? What's on the spring cleaning list?
I hate throwing stuff out. I want to find a use for it or give it to somebody else or something. And so we're trying to work our way through just random stuff that we have and using it in some way. So like the little sample bottles of lotion or different things like that. So, and a lot of that use is being handed off to my daughter to make her slime creations and anything else you can think of to mix things together and become her own little chemist.
Sounds good. So my wife has been doing a basement painting project, using up some old cans of paint, trying to, spruce things up a little bit, which meant all the toys from the basement came up to the first floor. Now they're starting to move back down. And my daughter's comment this morning was, "Dad, are we getting our lives back together?" And the short answer is no, but we're moving the toys back down to the basement. That's our spring project. So hopefully it's being wrapped up now. All right, guys. Well, thanks so much for the update. If you want more information, reach out to us at mortonbrownfw.com, and we'll catch up with you next week. Have a good one.